Have you ever heard of opportunity zones but weren't quite sure how they actually work or whether they're even worth considering? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we are diving into the world of opportunity zone investing. I'm your host, Pascal Wagner, and today I'm joined by Jimmy Atkinson, founder of OpportunityZones.com and host of the Opportunity Zones podcast, the number one show covering qualified opportunity funds. With over 20,000 subscribers and 10,000 investors served, Jimmy has become the go-to educator in this space. He's interviewed everyone from fund managers to the secretary of HUD and runs one of the top OZ summits in the country. If you want to understand how opportunity zones really work, where this space is headed in 2025, and how investors are using this strategy well beyond just multifamily, you're going to love this episode. And with that, let's dive in. Welcome, Jimmy.
Thanks, Pascal. Great to be here with you and excited to dive in and talk opportunity zones for a little while with you.
Yeah, I'm excited to nerd out. I feel like I and my listeners are chomping at the bit of just learning about new strategies. So there are a couple fun things that I want to make sure we get into today. You recently went to the Opportunity Zone 2.0 Summit, and you recently interviewed the Secretary of HUD, Housing of Urban, and you can correct me here in a minute, but
Yeah, I believe it's the Department of Housing and Urban Development. I trip over that sometimes too. That's why I just call it HUD.
totally. And I'd love to get into all of that, but just so everyone knows who they're talking to and kind of how you even got into space, can you walk us through your journey of how you got here? And also, I'd love for you to tie in a little bit about you being an LP investor in these types of assets yourself.
Yeah, absolutely. Well, it was July of 2018. I was sitting on my couch. I was kind of between projects at the time, which is code for I was somewhat unemployed or maybe underemployed if we're putting it gently. And I have a history of being a serial internet entrepreneur, launching websites and different media companies across different niches on the internet. And the podcast I was listening to on the couch that day in July of 2018 was the Meb Faber podcast. I don't know if you or any of your listeners might be familiar with that, but he had on the show this guest. And the reason why I clicked on the podcast episode to play it was the title was Never Pay Capital Gains Tax Ever Again. I'm like, oh, that sounds pretty nice. So I clicked on that and listened to it. And Steve Glickman of EIG, who is the architect of the Opportunity Zones program, basically gave me a 1-hour crash course delivered straight into my ears that day in July about opportunity zones. This was July 31, 2018, if I recall correctly. And I fell in love with the program instantly. I went to Google. I wanted to learn more about it. This is before ChatGPT, back when people still use Google, right? In 2018. And there was almost nothing on the internet about opportunity zones. It was a brand new program I learned. And I thought, this is really interesting. I wonder if I could put together a website about this topic and focus on building up an audience of investors and fund managers who are raising capital. And I'm not even sure how I would monetize it yet, but I just know if I put this resource together and build this audience, that at some point, if it's able to grow, I'll figure out how to monetize it later. As the months went by, I started to launch a podcast. I started to add new features to the website. I started to run some different events on the platform, and we helped actually connect a lot of investors with qualified opportunity zone funds and deals. And then in 2021, I myself had a capital gain event and decided, hey, I'm ready to make an opportunity zone investment myself. So I invested in a few different qualified opportunity funds myself. So now I was also walking the walk, not just talking the talk.
I love it. And you've had major, success in this very micro niche up until this point. So clearly, a lot of people interested. 20,000 subscribers. You've hosted a ton of different workshops. You said you've served over 10,000 people. Can you, I want to dig into it a little bit more later, but just give us like a highlight of what does your mastermind and do? What are you teaching people? How does that work?
Yeah, so I'll tell you what we just do at opportunityzones.com first, which is our free resource. And then I'll tell you a little bit about OZ Insiders, which is our mastermind group. So at opportunityzones.com, we just cover the opportunity zones industry as broadly and as deep as we can. And we educate all stakeholders in the opportunity zones ecosystem. So that's fund managers, real estate developers, business owners, accountants, attorneys, family offices, and high net worth individual investors and their advisors as well. And we exist to educate those folks about how opportunity zone investing works. Because it's a relatively new program. There's not a lot of information out there still. So we just walk you through in our free guides and across our podcasts how this works and some of the subtler nuances to the program. But we also try to encourage investment into these qualified opportunity zone funds through some of the events that we run. Our most popular event is our OZ Pitch Day event, which we run 3 times a year. And that's where we showcase a variety of different OZ deals for our audience of investors. And, over the last 5 years, we've hosted, I think, 13 or 14 of these events now, and we've had over 10,000 people across those 5 years register for those events. So quite a bit of traffic and transaction volume that we've delivered into the industry. I'm proud to say. Now, everything I just mentioned to you, those are just our free resources that we provide for folks who want to learn more about OZs. But for those professionals or more serious investors who regularly generate capital gains and want to have a programmatic approach to opportunity zone investing, we also have a mastermind group called OZ Insiders, where we get together once a month on Zoom for a live group coaching and peer networking session. And then also within that hour and a half long meeting, we do what I call a master class on opportunity zone investing. So a deep dive taught by a guest instructor, somebody in my network who comes on and teaches about one particular aspect of opportunity zones. In the past, we've had on former Senator Tim Scott's staffers to teach about what's going to happen with opportunity zone legislation. We've had some of the industry's most prominent accountants and attorneys teach classes on securities law for qualified opportunity fund sponsors, and some of the more technical nuances of what to do within a qualified opportunity fund if you have a sale of an asset within 10 years, technical topics like that, but also broad topics like how to invest in opportunity zone fund, how to due diligence opportunity zone deals, and so on. So a lot of really interesting discussions in that peer networking group, and it's been really enjoyable to run that. We just launched that one about 18 months ago and have had quite a bit of success with it so far.
I love it. Okay, incredible background. That really helps us kind of just understand who we're talking to. So thank you for that. What I'd like to do now is take a step back and pretend like I'm 5 years old and teach me about opportunity zones. What are they? When do they make sense? Who is it for? How does it help the economy? Let's dig into all of that.
Yeah, so I guess I'll tell this in 2 parts. Part 1 will be what is an opportunity zone and how did they come to exist? And then part 2, I'll tell you what is the tax incentive for investors who place investment dollars into opportunity zones, right?
I love it. Jimmy's giving us so much structure. It's great.
Thank you. Well, so opportunity zones came into existence in the 2017 Tax Cuts and Jobs Act, which was President Trump's signature tax cuts package during his first term, during his first year in office. The Tax Cuts and Jobs Act, several hundred pages of new tax legislation, delivered a ton of amazing tax cuts to the country. But buried in that hundreds long pages of legislation was a 6-page section about opportunity zone investing. And very few people knew anything about this. This was a brand new program that was created through a think tank called EIG just a few years prior. And it was actually incredible how quickly this think tank was able to get a couple of very prominent senators on board and some prominent congressmen on board in order to get their piece of legislation through. So what is it? So it's a place-based economic development program. And the entire intent behind it was to designate certain low-income census tracts all over our country and then attach to those low-income census tracts some really powerful tax incentives, which...
Census tracts.
Yes, census tracts. So should I explain what a census tract is?
Yeah.
Yeah. So every 10 years, the U.S. Census Bureau conducts a census, right? I think you're familiar with that. Totally. And the way that they do it is they collect information on every household in the country, like who lives here, what are your ages, some other bits of qualifying information. But the way they segment it out on a map is the U.S. Census Bureau actually creates these tracts, these geographies, these sections of the map where they are... Typically, they like to keep the census tracts around a population level of 4,000 people. So we have across the country tens of thousands of census tracts. I don't know the exact number off the top of my head. I think it is in the tens of thousands, though. Now, what they're able to do is they're able to figure out which of these census tracts are high income, which of them are low income. And the low income ones were then eligible to be designated as qualified opportunity zones. And so that's what happened at the end of 2017 when the Tax Cuts and Jobs Act passed. Was this program was created by this piece of legislation, but the first part of the legislation dealt with how do the zones actually get designated. So that's a process that unfolded over the first half of 2018. And what happened was the legislation called for the governor of every state, plus the governors of all the overseas territories, including the U.S. Virgin Islands and Guam and Puerto Rico, plus the mayor of Washington, D.C. Let's not leave out the District of Columbia. Each of the governors of those jurisdictions were able to designate up to 25% of their low-income census tracts as qualified opportunity zones. So that process was finalized in July of 2018, just a few weeks before I listened to that podcast episode I referenced earlier. And now there's a map of qualified opportunity zones that you can look at. There are over 8,700 opportunity zones across the United States, and they're designated at the census tract level. And hopefully you have an understanding of what a census tract is now. Just these little areas on the map, and they look really funny too, by the way. If you ever looked at a congressional district map where they're all kind of gerrymandered, census tracts aren't gerrymandered quite as much, but they are kind of oddly shaped. And sometimes in rural areas, an opportunity zone might be enormous, right? And in an urban area, like if you go to Manhattan, like one building might be its own census tract. So it varies a lot by where you're located, what type of place you're in. Anyways, fast forward again to middle of 2018, we have this map of 8,700 plus census tracts. Okay, so now what do they do? What are these census tracts? I'm going to talk about the tax incentive now. If you invest capital into one of these zones, as an investor, you get access to some amazing tax benefits. There were 4 tax benefits that existed at the beginning of the program. And first of all, I should state that this is a capital gains tax incentive. So you have to start with capital gains dollars. What are capital gains? Where do you get capital gains from? You can get capital gains from selling real estate, right? You can get capital gains also from selling stock, selling your privately held business, selling art or other collectibles. There's a lot of ways to trigger capital gains. In real estate, you might trigger a gain from selling a building, and then you might 1031 into another property. That's probably a program that a lot of your viewers and listeners are familiar with if they've done any real estate investing. Opportunity zones are similar in that it's a capital gain deferral program, but it's different in many ways, and I'll explain. You trigger a capital gain, and it doesn't just have to be from the sale of real estate. It can be from any type of gain. If you roll over that gain into an opportunity zone investment within 180 days, you get access to 4. Benefit number 1, you get to defer recognition of that gain until December 31, 2026. So the tax due on that initial gain is not due until April of 2027. Now it's 2025 when we're having this conversation. So that is kind of a bit of a head scratcher right now. Like, well, what I'm deferring tax for a year? That's right. They wrote that date into the statute. Now, back in 2018, 2019, 2020, the early days of the program, that was a pretty powerful benefit, getting to defer tax on that gain for 6, 7, 8 years. Nowadays, it's practically worthless. I'll grant you that. But stick with me. There's still some reasons why you want to invest in opportunity zones. Benefit number 2, and this benefit's now since completely expired, by the way, but for early investors in the program, if you got in early enough, you were able to reduce that 2026 gain amount by either 10 or 15%, depending on when exactly you came into your opportunity zone investment. That has since expired, but if you have an OZ investment prior to the end of 2021, you were eligible for that tax liability reduction on that initial gain. All right, benefit number 3 is the one that really knocks everybody's socks off. This is the big one. It's still available for everybody. If you hold your opportunity zone investment for at least 10 years, after 10 years, you go to sell the opportunity zone investment, you pay no capital gains tax on it at all. So let's say you roll over $1 million gain, and that gain doubles to $2 million. So you've got a new $1 million gain after 10 years. Normally, you would owe the federal government about $238,000 on that gain, not to mention state capital gains tax. Now, some states are different, by the way. Some states don't conform with the Opportunity Zone program, but the vast majority of states either do conform or don't have gains tax to begin with. But anyways, put that aside, you're saving $238,000 on that. Fourth benefit, and this is a big one that oftentimes gets ignored, but there's no depreciation recapture on Opportunity Zone investment sale. So oftentimes, if you're depreciating or if you're invested in a depreciating asset, when that asset gets sold, the IRS says, hey, we want that depreciation recapture. We're going to tax you at a rate around, I think it's around 20 to 25%, depending on what type of asset it is. With Opportunity Zones, you're good. There's no depreciation recapture tax whatsoever. So those last two benefits are still very strong and available for anybody who invests in an Opportunity Zone this year or next year in 2026. And unfortunately, for better or worse, the program is a perishable program, and it's scheduled currently to sunset at the end of 2026, but there is some legislation on the horizon that may extend the program.
So I want to dig into that legislation here in a second, but I think one of the things that's come to my mind is that it's not just multifamily type investments that get these benefits. That's originally what I thought, as in like they're trying to build better housing in these areas or more housing in these areas to draw people in to live there. Now I'm kind of starting to realize from watching some of your content that it's not just that. It can be an oil and gas opportunity zone or like, can you walk through a little bit of the other types of opportunity zones, I guess, in terms of asset classes there can be, and then why would a city state prioritize that?
Yeah, great question. It's kind of interesting actually, because when this concept was first conceived in 2015 is really when the Opportunity Zones program was first conceived within that think tank, the Economic Innovation Group, or EIG, as I referred to them before. They and some of the policymakers that they had on board their program, they had really conceived of this as a way to incentivize capital in small businesses that are located in these low income census tracts. That was really the original intent behind it. And it kind of turned into this real estate investing program. By the way, today, if you want to make an Opportunity Zone investment, it doesn't just have to be in real estate. There are some projects that exist to fund startup businesses or venture capital funds that will invest in businesses and Opportunity Zones. There is a way to make this a tax incentive to invest in businesses located in these Opportunity Zones. That said, I have estimated, and others have estimated, that somewhere between 75 to 90% of all of the equity raised by qualified Opportunity Zone funds to date has gone into real estate. It's a little bit more difficult to get businesses to qualify. You got to jump through more hoops. There's issues with the holding period. You have to hold the businesses for 10 years. That's a sticking point with investors. Real estate just seems to be more ready to go for this type of program for better or worse. So now that said, that's interesting. You thought that this was merely meant for multifamily. And to date, by the way, multifamily has been by far and away the largest real estate sector that has received Opportunity Zone funding. That does seem to be the most popular sector to invest in within real estate. But yeah, it can go into any type of real estate. I failed to mention, or maybe I just kind of skipped over it before, by the way, that the types of investments that you need to make in an Opportunity Zone fund has to generate new economic activity in these low-income census tract areas. The entire intent of the program is to catalyze economic development, catalyze new economic activity in these areas. So you cannot, for instance, just like you might with a 1031, a DST product, you can't just acquire an already stabilized cash flowing asset. You have to do one of two things. You have to either put a new building into use, so ground up construction, right? Development, or you have to substantially improve an existing building. So think of a dilapidated building or a vacant building that you have to, I'm not talking about just slapping some new paint on it. I'm talking about, doubling the value of the building is what you need to do in order to satisfy that substantial improvement requirement. So those are a couple of big hurdles. So this program is not meant for an investor who wants to do, core holdings or core plus holdings. This is development, or it's heavy value add. That's one thing that a lot of investors should realize.
I'm imagining, now that you're talking about it, there's kind of like a chicken and egg problem here. Like, do you build new housing, or do you invest in or promote these businesses that that will bring in jobs to a given area. Do you have any insight into how that was maybe supposed to play out versus how it did?
I think the policymakers weren't anticipating that how logistically and technically difficult it would be for businesses to qualify as opportunity zone deals. There are just some more hoops that businesses have to jump through. New businesses, for instance, they have to keep track of where their headcount is. They have to have a physical location in an opportunity zone. They have to have their employees come and work a certain number of hours in that opportunity zone. Then there's a question of, well, if your employees work from home, do we need to figure out, or do they live in an opportunity zone, or do we have to require them to come into the office certain days of the week? If you're selling a SaaS product or an e-product, where physically are your assets located? Is it in an office, or is it wherever the Amazon cloud servers are? Do you have to make sure your Amazon cloud servers are located in opportunities? So there's all these questions, and a lot of these aren't really bright line tests. They're subject to interpretation. I don't think the IRS has actually specifically stated in the regulations for all these different business types, 21st century type businesses, what are the requirements. So it's just more of a headache oftentimes to get businesses to qualify. Real estate's just easier. It's like this building is either physically located in the opportunity zone or it's not. Right? That's pretty easy test to satisfy. But business, there's a lot of murky gray area, and
Yeah, well,
it's just a little trickier.
I also imagine that businesses die much more frequently than
Yes.
a real estate being held for 10 years. The likelihood
Yes.
of a business falling apart in 10 years is significantly and orders of magnitude higher than a piece of real estate.
Yeah, of
Do
course.
you have
And
Go for it.
the entire tax incentive of the program relies on a profit to be made at the end of 10 years when you go to sell the asset, right? And if there's no profit there, if the thing's gone to zero, then there's no tax benefit, obviously. Now, with real estate, you could lose money, of course, right? Deals lose money all the time in real estate, but at least it's probably not going to go to zero, and you're more than likely going to have some appreciation over that time period with real estate. But I'll say this is a capital gains tax program, tax incentive program. And, with real estate, maybe you'll hit a 2x or a 3x or a 4x, somewhere in that range over a 10 plus year period, right? But so you'll save a pretty good amount of money. But could you imagine if the next Google was formed as a qualified opportunity zone business, and a unicorn that does 1,000x or a 10,000x type of return? Those are huge capital gains that you're saving on at the end of your hold period, 10 plus years out from now. I mean, that's I think really what the intent of the program was, and that's how I like to think of it when I'm looking at different opportunity zone business development deals. Those are the ones that are kind of interesting to me. Are these some of these startup businesses that are located in an incubator or an accelerator campus located in an opportunity zone, and they're able to bring in opportunity zone equity from investors, and that investor is thinking, boy, if this thing could go to zero, or it could pop and give me 100x or 1,000x return, that's a heck of a lot of tax savings I got.
Yeah, that's definitely an intriguing take. So,
Mhm.
so in 2025, do we have, or does the government have an idea of how this has played out? Like, has this been yielded as a heralding success? Is it we don't really know yet? I mean, I'm imagining all of that kind of fits into, do we do a opportunity zone 2.0?
Yeah. No, it's a loaded question, and it's a little. I'm going to get a little political on you here too.
All
So
right, all right.
I'll go back to the very beginning, or before the beginning. The Opportunity Zones program, as I mentioned a couple times, it was first conceived in 2015 out of this bipartisan economic think tank in Washington called EIG. There were Republicans and Democrats in that office working on this program. And when it came to be, it was largely hailed as a bipartisan program. And in fact, the initial legislation that dealt just with opportunity zones, it was supported by both houses of Congress, both chambers of Congress, I should say, the House and the Senate. And it was supported in bipartisan fashion. And what they did was they had to line up co-sponsors for this bill. And they brought them in two by two, just like Noah's Ark. For every Republican they got on board, they brought in a Democrat on both sides. And it truly is one of these things that rare these days, has broad bipartisan support. That said, that bill got packaged into a broader Tax Cuts and Jobs Act that became Trump's signature tax cuts bill. So what happened to opportunity zones after that point? The media went on the attack. The media hates Trump and they hate his tax cuts program, and they lumped opportunity zones in there. So throughout the second half of 2018 and into 2019, opportunity zones got a lot of bad press. There's a couple of bad articles about opportunity zones in the New York Times and the Wall Street Journal later that year, and other news outlets throughout the country that kind of bashed opportunity zones as a get rich program for Trump's cronies, for Trump's real estate cronies. So for better or worse, opportunity zones were passed in by broad bipartisan fashion, but were a part of Trump's signature tax cuts, and they were administered by the Trump White House when they first rolled out. I do oftentimes wonder if opportunity zones had been passed by the Obama White House a year earlier, potentially, what type of how they would have been received by the mainstream media. I think they would have been received in much more flattering terms. Let's fast forward to today, 2025. How have opportunity zones done? What do people think about them? What's the general consensus about opportunity zones? It's mixed, quite frankly. I do still think they enjoy broad bipartisan support. There are mayors of some of our largest cities, which are almost entirely Democratic-led cities, that really love opportunity zones for the capital that they brought into some of their inner cities or their lower income areas that would not have otherwise flowed in. Governors of both red and blue states enjoy the capital that's come into their jurisdictions. And to date, estimates of how much equity has come in through this Opportunity Zones program ranges from anywhere between $80 billion, $250 billion, a pretty wide gap. I've estimated it's probably roughly $160 billion, but nobody knows the true number. There hasn't been a lot of reporting on this just yet. So a lot of it's just based on estimates and surveys. But to put that into context, it dwarfs the second most popular, what was previously the most popular economic development program in this country, a program called the New Markets Tax Credits program, which raises somewhere in the order of $3 to $5 billion per year. This has raised $160+ billion in the last 6 years. So just an order of magnitude larger. Now, where is the capital gone, right? That's the big question. Is it going to areas that would not have received it otherwise? Is it going to areas that are actually beneficial to the community? I think there's been cases where that has not been the case. I think in some cases it's probably gone to areas that maybe should not have been designated as opportunity zones in the first place. I think maybe it's going to areas that are gentrifying the existing population. I would say, though, there are certainly cases of that. And that's one of the biggest criticisms of the program. But I would say on the whole, if you look at the entire land of opportunity zones, you can pick out a couple of bad apple stories that make the whole program look bad. But on the whole, a lot of capital has gone into areas that otherwise would not have received it. And to date, it has helped build over 500,000 housing units all across this country, a lot of which probably would not have gotten funded if not for this program. So, and it does more than that. You mentioned that, you thought it was a multifamily program. It has mostly been multifamily that's been done, which is great, but it does a lot more than that too. It has helped build hotel. It has helped build industrial. It's helped build small businesses, mixed use, student housing, senior housing, in addition to just traditional multifamily, a couple of different subtypes of multifamily there. So it's built a lot of real estate and businesses all over the country, helping to put more housing supply online, which is drastically needed in this country with the housing shortage we're going through. And it's helped increase the local tax base in those jurisdictions as well, which has been very helpful for a lot of these low income areas all over the country.
Do you have a story or maybe can you pinpoint a city that you might know of where it had 4,000 population and then, X amount of money flew into this area and now, the population is Y? Anything like that?
I don't have any hard data. I don't know if anybody does because I don't think the numbers have been crunched yet to say this one particular census tract has exploded because of this. But I can point a couple of case studies out. One is one of the rougher neighborhoods in Los Angeles, South Central Los Angeles. There's an operator there called Sola Impact, and Martin Moto over there, the founder and CEO of Sola Impact, he's been developing in South Central for many years, even prior to opportunity zones. But when opportunity zones were enacted, he decided, hey, wait a second, let me start seeing if I can raise some opportunity zone funding from investors, now I can offer this really unique, powerful tax benefit for some of my investors if they invest with me. And that helped grow his business substantially and helped bring more housing units online in that area of Los Angeles where it was drastically needed. And he also even built an incubator campus for small businesses called the Beehive there in South Central Los Angeles. If we go up the state, I'm from California originally. I'm in Texas now, but there's quite a bit of activity in California. Up the state to downtown San Jose, there's a group there called Urban Catalyst that's helped build a lot of student housing for San Jose State and hotel and other multifamily, just general multifamily up there in downtown San Jose. Downtown San Jose's a little bit of a rough spot. It's not too exactly like Midtown Manhattan. I guess I would say it's a little bit dead in some spots, and it needs a little bit of help getting revitalized. And the interesting thing about downtown San Jose is that Google is expanding down into San Jose. As you know, Silicon Valley has exploded over the last several decades. And with that, they've kind of run out of space. So they're having to expand outward from that central location in Silicon Valley. And San Jose is in the path of progress. And this group, Urban Catalyst, is helping to kind of roll out the red carpet by revitalizing that area with Opportunity Zone funds over the last several years. And there's many more case studies like that all throughout the country. Another group I'll highlight is Capital Square on the other side of the country in the Mid-Atlantic region, doing a lot of rebuilding of Virginia and Tennessee and North Carolina, but in particular in Richmond, Virginia, they've developed, I think, a half dozen or so multifamily buildings, building up the Scott's Addition neighborhood of Richmond, Virginia, and really transforming that area. And the interesting thing about what they've done is they haven't torn down any existing buildings. They haven't pushed out any existing residences. They're typically acquiring just raw land and putting up something where nothing previously existed. So they've helped bring thousands of housing units into the market and have created a lot of jobs too over the last few years. So just to highlight a few right there, but I've got many more, of course.
Yeah, I love that. So we were just talking about how this program is actually coming to an end. One of the first major benefits of being able to delay your capital gains is kind of like a moot point at this point because you can only delay your taxes for a year and maybe becoming less interesting. You recently went to the OZ 2.0 summit. Can you talk to us about that? I'm assuming, correct me if I'm wrong, that's related to maybe, OZ's 2.0, maybe Trump bringing in a second round of this in order to spur more economic development. Can you talk a little bit about that and what's ahead?
You got it exactly right. Yeah, I mentioned a little while ago that Opportunity Zones are a perishable tax incentive. The program is scheduled to sunset after that deferral date of December 31, 2026. Essentially, the legislation that exists says that you have to trigger a capital gain prior to the end of 2026 in order to be eligible for these tax benefits. So that means if you trigger a capital gain on exactly December 31, 2026, first of all, you don't get any sort of deferral period, obviously, but you do still have 180 days beyond that point to make a qualified Opportunity Zone fund investment. So that would take you out to close to the end of June of 2027 is really when the program is going to wind down, about midway through 2027. And after that point, there really can't be any more Opportunity Zone deals that get funded. So what is happening right now in Congress on Washington, D.C.'s Capitol Hill is what some insiders are referring to as the Super Bowl of tax. Because what is happening is at the end of this year, 2025, as well as at the end of next year, 2026, most of the provisions of the Tax Cuts and Jobs Act are expiring end of this year. Some of them expire at the end of next year, Opportunity Zones being one of them. So Republicans have swept the last election way back in November. They now control the House, the Senate, and the White House. And it is one of their top priorities to extend the Tax Cuts and Jobs Act of 2017 and potentially even make a lot of those, if not all of those tax cuts included in that legislation permanent. So that is a huge priority in Washington right now for the Republican Party. Now, their margins in the House and the Senate, with the House in particular, is fairly narrow. So they have to get a lot of different caucuses on board with the plan to extend these tax cuts. But so far, so good. They've gotten through several procedural hurdles so far. And I'm hopeful that sometime toward the end of this year, 2025, we will see the Tax Cuts and Jobs Act get renewed, and we'll see opportunity zones get extended or renewed in some fashion going forward. And that could work in a couple of different ways. There's a couple different ideas circulating within the industry. One is taking the current program, right, and this current map of 8,700 plus opportunity zone locations all over the country, and just extending that current program by an additional 2 years. So now the deferral date would be pushed out from the end of 26 to the end of 2028. Give everybody just 2 more years to get their money in, get their projects funded, get their capital gains deferred. Whichever side of the fence you're on, it'd be a good outcome for the program. There's another idea circulating, which is, okay, let's let this current program expire at the end of 2026 as planned. Then January 1, 2027, let's start a brand new program and let's use a new map. Because if you think about it, the census tracts, they are getting a little bit stale. The data that was used to create the opportunity zones is a decade old by now. So let's just do the whole process all over again. Let's give the governors of every state another bite at the apple. Let them designate new opportunity zones. And there may be some tweaks to what the eligibility criteria of designations would be. That's TBD still. And then let's roll the program out and just start it all over again. And there's a few different really interesting ways that have come up to enhance the program going forward, starting in 2027, or I should say, starting as soon as 2027. And that's what that OZ 2.0 summit that I went to in Park City recently was all about. It was designed to drive that policy conversation forward with a lot of key players, influencers, and stakeholders in the industry. Hey, what do we actually want? What do we want this legislation to look like? So, if you want to, I can walk you through a few of those ideas. Some of them pretty solid, some of them kind of wild, but would be nice to have.
Yeah, I would love to dive into those.
Yeah. So first of all, like the primary idea is let's just make the program last longer. Let's give us more time. Let's start it over again. Let's give us another 7 to 10 years of driving capital into these low income areas all over the country. So if nothing else happens, if just opportunity zones get renewed just as they presently are, it'd be a great outcome. But there are a few tweaks that can be made to the program to make the program even better. Well, I think maybe the most popular idea is, why not allow all types of dollars to participate in the program? Because currently only capital gains dollars can participate and receive all of the tax benefits associated with opportunity zone investing. But what if you allowed non-gains dollars? Ordinary income could participate. Maybe after-tax dollars could participate, and they, after-tax dollars wouldn't get the deferral period, and they wouldn't get that reduction in capital gains tax liability extended to them. That's fine. But the big benefits, no capital gains tax on the back end after a 10-year hold, that's huge. No depreciation recapture, that's huge. Why not allow non-gains dollars or after-tax dollars to participate in those two benefits? So that's maybe the biggest idea. Another idea is, why have a deferral date written into the statute? Because currently the legislation, the Internal Revenue Code, section 1400Z-2, look it up. The date, December 31, 2026, is etched into that piece of paper right there. And some have thought, well, why are we doing that? Why not allow for rolling deferral periods? Maybe extend to an investor a 5 to 7 year deferral window, no matter when he or she comes into the program. So if you invest in 2027, you get a 7-year deferral until 2034. But if you come in 2028, you get a 7-year deferral until 2035. Just make it the same amount of deferral for everyone. So that's another type of enhancement that we could provide potentially. A couple more ideas that are popular are, let's make the incentive stronger for certain types of investments. So right now, you deploy capital into an opportunity zone business or an opportunity zone real estate project. It doesn't matter what type of project it is, everybody gets the same benefit. But what if we put some kickers in for certain types of social goods like affordable housing? Could we somehow make the incentive more attractive if you're sinking money into affordable housing or rent controlled housing, something like that. That's one idea. What about rural? There's a lot of people calling for making the program better for rural development. Rural development's tough, not just within OZs, but just in general, just because the infrastructure is not there and the juice isn't worth the squeeze for a lot of investors. So maybe the Opportunity Zones program can be structured so that there's additional incentives if your capital gets deployed into rural areas. So those are a few of the ideas that are circulating. But first and foremost, I would say let's at least just get the thing extended. If we can get any of these other wild ideas into the program, the better. But as with all things, there are trade-offs, and the one big trade-off here is yes, this would make the program a lot better, and it would incentivize a lot more investors to come into it. It would incentivize a lot more capital to come into the program. Maybe some of these ideas could double or even triple the amount of capital that comes into the program, but it comes at a cost, right? And so that's what Congress is weighing right now. There's a lot of Republican congressmen that are saying, hey, this is going to end up costing too much if we offer all of these different types of ideas. So that's kind of the back and forth that's happening right now between some policymakers and industry leaders.
Are you an activist in any way? Are you like trying to influence how these get done? Do the average investors participate in calling their local congressman and saying, hey, we want this? Or is that not really a thing? And it's more of
it's absolutely a thing. And yeah, we're very active. So I'm a member of the Novogradac Opportunity Zones Working Group. I also work closely with some folks over at the America First Policy Institute. And, one of their directors just became a chief economist at the White House. So I have these contacts within the industry who have the ear of people in Washington, either on Capitol Hill or in the White House. And I am constantly telling people, if you are an Opportunity Zone stakeholder, if you are a developer or a business owner or an investor, and you've seen some good that this program has produced, please contact your member of Congress, contact your House rep, contact your senators, write them a letter, call them, get a meeting with them, have them come to your site and tour it if you've used OZ capital to fund a development project. That's really powerful. That goes a long way. As many senators and congressmen as we can get on board with Opportunity Zones, the better. Now, that said, in the grand scheme of things, Opportunity Zones are a pretty small drop in the bucket, quite frankly, when it comes to tax legislation. There are so many different ideas in this big tax legislation bill that's probably going to get through Congress later this year that I don't know how much Opportunity Zones actually moves the needle, but every little bit helps. So I do have folks on my podcast, members from the Novogradac Opportunity Zones Working Group, another trade association I work very close with, the Opportunity Funds Association, and then staffers from Senator Tim Scott's office in particular. Senator Tim Scott has been really one of the biggest champions of the program since program inception. We've had some of his staffers on our show from time to time, and they all tell the same story. Let's get the good stories about this program told so that policymakers, lawmakers on Capitol Hill hear it and want to get behind the program. So yeah, we're very active there in that regard.
Yeah. So call to action here. If this is something that's important to you, reach out to your local congressman.
Yeah, you can do something about it. Absolutely.
So you had this conversation with the Secretary of HUD. Talk to us about what you've learned. How are they thinking about this? What did you learn from that conversation?
Yeah, so this was actually a few years ago. I want to clarify, before he became the Secretary of HUD. Then this is Scott Turner, is the individual that we're talking about. And back in 2019, after Opportunity Zones were off to the races, so to speak, President Trump, during his first term in office, really wanted to put the full weight of the White House behind supporting the program. So by executive order, he created a new office within the White House called the White House Opportunity and Revitalization Council. And it existed to support Opportunity Zones in any way that it could, offering technical assistance, going on speaking tours all over the country. And the executive director of that program, the individual he put in charge of that program, was an individual by the name of Scott Turner, former NFL football player, currently a pastor, not too far from where I sit right now in the Dallas area, Dallas, Texas. And so it was really interesting when, after President Trump served out his term, they were very involved in the White House with supporting opportunity zones. Biden let the program dissolve. So we didn't have that office at all for his 4 years. And then when Trump won the election in 2024, before he took office, he announced a lot of his cabinet positions. And I loved it when I learned, I think it was probably sometime in December or early January, that he was going to name Scott Turner as the Secretary of HUD. I was like, whoa, that's pretty cool. This is a cabinet level member now who got his start because he was specifically supporting the Opportunity Zones program. So all of this is to say that the White House currently under President Trump has been very supportive of Opportunity Zones, to the point where they've named their former Opportunity Zone czar, essentially, as Secretary of HUD. So the conversations I had with Scott Turner took place. I had him on the podcast a couple of times. I met him in person in Dallas for our first conversation. We actually did most of the podcast recordings that I do are like what we're doing right now over Zoom or some other type of platform where we're online interacting with each other over a computer and cameras. But I actually had a sit down at lunch with Scott Turner back before he was a cabinet member, and he was talking glowingly about Opportunity Zones, the great work that it had done already just in the first year of the program, and the different speaking tours he had gone on all over the country to highlight some great examples of Opportunity Zones in the early days. And then I had him on again in 2020 to kind of give me like, okay, it's been 1 year now. What has your council, the White House Opportunity Revitalization Council, what have you guys worked on over that past year? And he had some very interesting things to report on. And specifically, it coincided with the release of their 1 year report on that office's work with Opportunity Zones. So I haven't had him back on the podcast yet since he became a cabinet member. I have reached out to him and his team, and I'm hoping at some point we can get him on the show later this year.
Okay, Jimmy, for all those who are listening, right? Like, so you're interested in Opportunity Zones. If you're an LP and you're listening to this, you're interested in Opportunity Zones, and you even being an Opportunity Zone investor yourself, you've invested in a couple deals. I'd love to kind of like round this out with, what are the nuances that we as an LP investor new to this type of strategy should be thinking about, be aware of? Where can we go wrong?
Yeah. Well, first of all, I'll say I'm not a financial advisor, and this is not meant to be financial advice. Okay. I got to get that out of the way. And I would urge everybody, please consult with a professional advisor, your CPA or accountant, before making any investment decisions. But that said, the first thing I would do is I would look holistically at your entire investment portfolio and consider, what do you want your asset allocation to be? How weighted do you want to be in, and I'm just going to assume now for our purpose of the conversation, real estate. How weighted do you want to be in real estate versus stocks versus bonds versus other hard assets? And so think very carefully about that holistically. Now, that said, once you determine what you want your asset allocation to be, let's talk about that real estate part of it. Opportunity zones, as I mentioned earlier, and I'll repeat it again now, these aren't core or core plus holdings. These are heavy value add, more opportunistic, sometimes actually ground up development deals. In fact, more often than not, they're ground up development deals within the realm of real estate. So consider what your risk tolerance is, and also consider what your preference for illiquidity is, because these are alternative assets. These are real estate holdings that are going to be illiquid. And in the case of Opportunity Zone real estate, they're oftentimes not going to provide any cash flow for the first few years, because those first few years are used for construction or for the rehabilitation, and they're not going to be stabilized for a number of years. So just know what you're getting into. I always like to caution people about that, because oftentimes people who invest in Opportunity Zones, they might actually not be real estate investors previously, because the gains don't necessarily have to come from real estate like they do with a 1031. If you do a 1031, you kind of get it. You kind of understand real estate investing. You know what you're getting into. But a lot of these, one of the brilliant parts about Opportunity Zone investing is it opened up real estate investing to this new class of investor. You may have gone and sold some stock holdings earlier this year when the market tanked. Hopefully you didn't, because it rebounded pretty quickly. But if you did, you probably triggered a pretty large gain if you had been in the stock market for any period of time. Just take a look at the S&P 500 chart over the last year or 5 years or 10 years or 20 years. No matter when you got in, you're almost certainly sitting on a big gain that you just triggered if you exited any stock holdings. Just because you're a stock market investor doesn't mean you know much about or even the first thing about real estate investing. So that'd be my first word of caution would be just know what you're investing in. You're investing in an illiquid asset that's probably not going to cash flow for several years. You're doing it not for cash flow or capital preservation as much as you're doing it for capital appreciation. These are going to be, you know, probably more reward, more risk type of real estate deals than an average real estate deal, just because of what opportunity zones are trying to accomplish as a policy. Remember, catalyzing new economic activity in the area. So it's got to be a new building or a substantially improved building. And those can come with a little bit more risk. And then once you kind of get your mind around that, then you can kind of consider, okay, what type of deal do I want with my opportunity zone investment? And that's a strategy that you and your advisor really have to kind of uncover on your own. But there's a lot of different strategies, and there are a lot of different types of funds out there. There are multi-asset funds, which can get you exposure to a pretty broad group of holdings, national multifamily potentially, or at least regional multifamily. You could also go into a specific deal. If you want to go into a specific deal, you might be interested in one particular deal in San Antonio, Texas, let's say, right? But then what sector do you want to invest in? Do you want to invest in multifamily? Multifamily is pretty plain vanilla, pretty safe, right? The cap rate spread is pretty narrow right now against the 10-year treasury. So you're not really going to get a lot of reward, at least, as we're conducting this interview in April 2025, a lot of multifamily deals don't pencil. Maybe you want to get into something like hotel or industrial, and then regionally, you can pick from basically anywhere in the country. You can go to a hot area like the Southeast or Mid-Atlantic or Texas. There's a lot of opportunity zone investing being done in California. Maybe you can go somewhere a little bit not so hot, maybe a little contrarian view. Maybe you want to do something in the Midwest. I mean, depending on what you want to do, there's something for everybody out there. There's so many opportunity zone deals that I've basically seen it all over the last 6 years. So do it thoughtfully, do it carefully. Make sure you actually do have access to a pretty good amount of deal flow before you make any decision. You don't necessarily want to jump into bed with the first deal that you see. Make sure you see a few different OZ deals. That'd be my advice for somebody new. Hope I didn't miss anything there.
Yeah, no, and a lot of these benefits are if the deal does well. And I think a little earlier you highlighted that, if you're investing in a business and the business goes out of business or doesn't generate a profit, then you don't really get the value. So can you just quickly maybe talk about the downside scenario of if the project breaks even or if it doesn't, or you maybe even lose some money on equity in the deal?
Yeah, and that's definitely possible. Investing involves risk. Sometimes the deal doesn't work. Sometimes the deal doesn't work because the operator sucks and it's mismanaged. Sometimes the deal doesn't work not because of the operator, but just because of some externality that can't be controlled. The tariffs, increasing construction price, interest rates getting jacked up. Just some things that are just out of our control. I'd say one of the nice things about OZ investing is that it does require a 10-year hold. So hopefully across a 10-year period, you're going to get some appreciation. It's possible that you won't. But I would just say, and this isn't confined to opportunity zones, deals do go south for any one or more of a number of reasons. And I would caution people, just because it's an opportunity zone deal does not instantly make the deal good. The opportunity zone tax incentive can make good deals great, but it can't fix a bad deal. If the deal's bad, it's just bad. Okay, so that would be my advice is, just be aware of the fact that there is a risk that you're going to lose some of your principal, probably not all of it. If it's a real estate deal, the dirt's going to be worth something at the end of the day, I'd like to think, unless there's some cataclysmic apocalyptic event 10 years from now that we can't foresee. Business is obviously a lot riskier, right? Businesses absolutely can and do go to zero all the time. But then you also have a lot higher potential for a really big X or X pop if you hit that next unicorn, right?
Absolutely. Jimmy, this That was an incredible introduction and overview of opportunity zones. Where can people find more about you, your podcast, maybe the deals you have?
Yeah, thanks, Pascal. Really appreciated spending some time with you here today. Hope this has been helpful. You can head to opportunityzones.com/download if you want to download my free beginner's guide to opportunity zone investing. And also, if you just kind of peruse around opportunityzones.com, the website, we've got a lot of interesting sections on that website. We've got an FAQ section. We've got a podcast. We've also got OZ Pitch Day, which we host 3 times a year. It's our free event for investors where they can get access to OZ deal flow as well as receive some education throughout the course of the day. Thanks for having me on, Pascal. It's been a pleasure.
Yeah, I loved having you. Also, if you want to see more Opportunity Zone funds like the one Jimmy mentioned, we also have those in our starter kit that you can get at passiveinvestingstarterkit.com, which is one of the ways to also just see a bunch of different deals. So thank you again for being here, Jimmy. And here on the Passive Income Playbook, part of the Best Ever CRE show, we drop new episodes every Thursday. So be sure to tune in each week for more conversations like this, strategies and stories to help you grow as a passive investor. As always, if you enjoyed today's show, please leave us a review. That helps us get more amazing guests like Jimmy. Thanks for tuning in. I'll see you next week for another episode of the Passive Income Playbook.